You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good morning, Jim.
It looks like short covering continues on the major equity markets.
Oh, yeah, this has been one huge short covering rally. It started with a first of all, out of the big hit back in late August, we got the rebound in the S&P up to a momentum measure that we were looking for, and then it was eroding down, and then there was kind of a bad week going into a Federal Reserve comment, and it was the unemployment figure. It came out. There was the number is calculations bogus anyway, but nonetheless there's a continuity to it, and this thing, the continuity had changed. It was a bad unemployment report, so things were soft, and then the word went around that, this is so bad that then the Fed won't have to raise rates. So that then started the short squeeze in virtually everything. You've had stocks and junk bonds up. You've had base metals and other commodities rallying. So it's been quite a free-for-all. So somewhere in here, we expect this one rebound to run out of momentum. But also we're in somewhere approximately where the decline in the stock markets, like the U.S. stock market set its high in July, using S&P, on the seasonal would likely find a low. And then also we looked at one way, which was that when the senior index dropped below the 50-day moving average, that was an important point. And then we looked at 2001 or 2007, and that then counts out to a slide of maybe 3 to 4 months, which gets us to October, November. So I think a week ago we noted that somewhere within the next 4 or 5 weeks, this period of selling pressure should be pretty well concluded, and in which case you would look for churning around rebounds into the spring. But we think it's the first step in a well-earned bear market. The bull market was fabulous. It was beyond any sort of valuations by way of earnings or economic growth. A lot of the earnings were manufactured with, although poor top-line earnings, they financially engineered it to good stuff by reducing number of shares outstanding and borrowing money and buying back stocks. It was all very reckless behavior by corporations. And of course, it was matching the more than reckless behavior by the central banks, who have this fixation that they can manage the economy. That used to be sort of a direct equation. And then now, in the last decades, they can manage the economy through manipulating interest rates and driving stock prices up. And they figure that the wealth effect from rising stock prices will feed off into economic growth, which doesn't seem to be happening. Although you've had like crazy booms in automobile sales, that's for new vehicles, and you also for used vehicles, and this is all being done on 6 and 7 year payments. And then there's, of course, Wall Street's got into it and bundling up a whole lot of small car loans into big bond deals for the institutions to buy. So it seems similar to the craziness that was going on in the house market in the U.S. in 2006, where everybody was buying on the never, and then there was considerable disappointment.
Of course, the difference between a car and a house is a house usually appreciates, a car depreciates $5,000 the second you turn the key.
Oh, yeah, that's true. That's true. So anyways, and then speaking of houses, I saw one here just recently that some places in the U.S., high-end stuff, like some place in Maryland, the county is apparently about the fourth wealthiest county in the U.S., and their high-end prices had stalled out. Some people taking quite a drop from the asking price to what it eventually traded at. So there could be others in the U.S. of this. And, of course, one of the things we've been looking for and following is the one in Los Angeles where a contractor is building a spec house up on a hill, and he hopes to sell it for $500 million. So anyways, we'll watch that one from time to time and see how that one goes, but it certainly sounds precarious to me.
Well, there might be one customer. You just need one.
All you need one is one, that's right. Well, the marketability in houses is not that great. So anyways, what we're looking at here is perhaps the huge short squeeze is just about finished. We'll watch for that one. Meantime, you've had also a correction that's gone on for a week now in credit spreads, and as our listeners will recall, that one, the credit spreads really did us a favor in June when they turned around and started widening and then broke out on the key breakouts in early July and early August. So that was, as that was happening, the Chinese Shanghai market was falling all apart. And when you look back on it, Jim, that, I guess, depending which index you're looking at in China, but a 35 to 40% hit really is serious and severe. And it hasn't really gone down and tested that low yet, whereas the S&P, once we got the 24th disaster, our target was it would go down to the low close on that day, which a number of key indexes have, and then sort of a backup reserve here. If it goes down and takes out the intraday lows, the extreme lows, then it would mark an extension of the bear market. But that hasn't happened yet. As a matter of fact, the short squeeze has taken it well away from there. But it's gone up so steep that it's vulnerable. So, but you know, one of the and then within this, you had a sharp, quick bounce in base metal prices, and this put a squeeze into some of the beat-up base metal resource stocks like Teck, for example, one of them. And what's the other one? Glen, whatever it is. These things have gone straight up. Like one of them was up 10% in one day. So there's immense short squeezes going on, which is, well, while they're fun to watch, they do take those bids, underlying bids, get forced to cover at high prices. So those short positions are reduced, which means there's much less of a bid below the market when on the next leg down, which we're not sure when it's going to happen.
We'll have more with Bob Hoye right after the break.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Bob Hoye. Bob, what's happening with gold?
Gold sector is looking positive. A couple of weeks ago, we noted that we like to look at stability in the gold sector to build a base here. The rallies since the bear market started in 2011 have been sharp. Even the one a year ago coming out of December was, the first part was straight up. So it's this kind of stuff whereby the disappointed bulls say, this is it, we're finally going to be rewarded, let's get on board, and the stock and the rally gets up there, and then, there's nobody to take it any further, and then the decay came in again. So this quiet bottom in here over the last 4 weeks is constructive. It also shows that eager bull, he's not around anymore, and so our gold shares divided by gold, that has been improving and above the 50-day moving line, which is very constructive, and the sector is improving. There's also, as I said, there was a sharp rally in base metal prices, but I think this is sort of just a short covering. The chart for the gold and gold stocks looks much more constructive. And then the other one we should mention is the crude oil. Of course, that got tagged into August with the financial hit, and you'd expect a rebound. There's a seasonal rally for crude oil can go up into September, and obviously this has continued. So I think somewhere in the next week, crude oil will be on this rally will be maxed out, and then often there's a seasonal low for crude oil. It's sort of like December, January kind of thing. Also, you can have a seasonal low for copper, like around November. So I think there's a little more down in commodities before year end, and then maybe in the spring one can look for a better rally.
Bob, thanks a lot for chatting with us.
Jim, it was good to be with you.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com Radio. Find us on Twitter at Talk Digital Net. You can also catch us on YouTube on Talk Digital Network. You can forward comments about the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.